All right, welcome back to our PRB webinar. This is webinar number 13. Thank you for joining us in the month of August on a Thursday evening at 8 p.m. Very delighted to see you. And today I'm back with Rong. And we are going to talk about the cooling measures, in particularly on this particular topic on how can you safeguard your property investments from future cooling measures. Because up to date, we have about 15 to 16 rounds of cooling measures ever since year 2009. It has been close to 16 years of cooling measures already. The latest round was 27 April 2023 this year, where ABSD was increased from 30% to 60% for foreign investors because that was a much needed ABSD cooling measure. We're going to talk about what has been some of the price performance on residential property across the board. And we're going to look at HDB apartments. We're going to look at condos and landed. How has things changed from April until today? Because that has been about 4 months. Sorry for the announcement in my office building. And then, why is it that we are coming out of this particular topic for tonight? Because there are some implications on how you should plan for your property investment. And most importantly is that we want to advocate a certain key few fundamental principles. One of it, which I think you have already heard of before, is that we want to advocate the part that we should not time the entry point of your residential property, especially if it's your first one. So these are the three things that we're going to talk about. Relationship between cooling measures, price performance, positioning your portfolio for success, and last but not least, how do we use disparity effect as a methodology to safeguard against future cooling measures. Quick disclaimer, these are meant as research purposes as well as education purposes, and a lot of the things that we're going to talk about stems from our opinion as well as what has been derived from PRB research team. Going straight into this, 27 April 2023, 60% possible impact. And I think especially after this cooling measure has came out, Rong, I think this statement makes even more impact in a sense that it just shows that timing the market created more risk, especially if you're trying to time your first residential property, or especially if you have already sold off your property 2 years ago, 1 year ago, you're in a rental situation now. You will just realize that not only has rental increased, and it's still increasing later as we look at some key statistics, but price is not coming down. What do you think, Rong, on this portion?
Absolutely correct, because there are two main focus to look at when we're trying to time the market. Is number one, most of the time, if you are looking at a very strong asset class, it's usually on a long-term uptrend basis. Of course, over time, there might be corrections or there may be major meltdowns. The question to ask is whether is there enough time for us to enter when there is a major meltdown, and whether if there is any correction, is this price discount significant enough for us to wait? So most of the time, I would say that when people are trying to time the market for something that is less liquid, like a real estate market space, usually it doesn't turn out that well because the costing wise, will be higher. I think next thing is also, it will be with all the cooling measures coming in place to try to make sure that we have a stable kind of price growth. Every time a new cooling measure comes in, actually we will need to deploy more resources to actually enter into the market. So that also means that this also comes additional risk when we are trying to wait and see while a new policy comes in.
Yeah. Because most of the time when we see this kind of policies, right, Rong, is that the first thing that comes into our thought process is that, hey, I think prices are going to come down. Let me wait for 2 more quarters. And after 2 more quarters, if prices are still not coming down, let's wait for 1 more quarter. And what is going to happen is that if you're in a rental situation, especially with a family, if you're paying at least $5,000 to $6,000 for, let's say, like a 3-bedder in the OCR region, even 1 year is going to burn up about $72,000 in cash. 2 years is going to burn up $144,000 in cash, which sometimes, if you add on to the fact that for this next 2 years, if the particular type of property that you were initially aiming for in 2023, and you only enter in 2025 because you just tell yourself that, okay, I should stop waiting. And let's say the price would increase by another 200,000 plus your 144,000 rental, that is a total loss of 344,000. And of course, every cooling measure, like what you mentioned, creates lesser opportunities. Let me maybe just share an illustration. Just for example, in the past, our LTV was actually at 80%. Last time, all you need to do is just to put in 20% down payment, out of which 5% from cash, 15% CPF, 80% from the bank. Now we are already at this new situation, 25% down payment, 75% from the bank. We will not be alarmed if, let's say, prices were to continue to creep up. And maybe, I'm not sure, I'm not trying to
Speculate.
yeah, and I hope that it won't happen. But let's say, for example, next year or the year after, prices are not coming down, government feel that they need to restrict even more. And let's say if they were to bring this down to 70%, and you have to put in 30% down payment. Now, the very first thing that will happen potentially, number one, is that this additional 5% that you put in, maybe you'll say, oh, it's better for me to put in more down payment into my home. Of course, there's nothing wrong. You can put in more equity into your property. But actually, from a leveraging and an investment point of view, by right, this 5%, for example, if this is a $2 million property, a 5% is an additional 100,000. This 100,000, firstly, it takes time to build up. And even if you have that 100,000, why don't you put that 100,000 into a blue chip fund to give you a 6 to 7% dividend per annum? Rather than you put it into your property itself, where actually you can leverage for the bank, because now, in terms of SORA rates, is about 3.5% average. You can actually double your returns based on this 100,000. This is just a very simple illustration on the power of leveraging, because when you leverage, real estate is one of the most premium kind of collateral that banks love, because all they want is basically for you to give them the interest for the amount that they leverage to. This is principle number one. Number two, this is also one of the type of investment category that banks do not need to share in your profit. Let me just give out this key statement, because when your property appreciates, the bank is not interested to share in the appreciation portion. Let me give you an illustration. Let's say, for example, in the year 2022, last year, you bought a property at $2 million. You put in 25% down payment, 75% from the bank. The property is valued at $2 million. You enter into the property. Let's say after 3 years, in the year 2025, it appreciated by 20%. And we just calculate a very simple illustration without factoring in over the past 3 years, you have already paid down a little bit of a mortgage, and of course, all the stamp duty payments and stuff. Let's just do this very easy calculation. If you appreciated by 20% to 2.4 million, $400,000 increment in valuation, and you decide to sell this property in the resale market, and you successfully did it. A very clean-cut kind of calculation just to illustrate this main statement is that the bank, though they loan you 1.5 million, and they technically own 75% of your property, but the entire title belongs to you. Of course, they lodge a caveat against your property because in the sense that they were the ones that loan you 75%, but they will not come knocking on your door and say, hey, now you have made 400,000, give me 75% of this because I am a shareholder in your property. It does not work in this way. All they are interested in is that when you sell a property, I have the first charge. Please return me the outstanding loan of 1.4 something million. And of course, you have to make sure that over the past 3 years, you can sustain the installment payment. That is what they are interested in. They are interested in the interest payment and for you to repay the loan. So this 400,000 is your own appreciation based off your 500K down payment, which if you look at the cash on cash return, this is different and this is significantly different. And this is how leveraging works in the real estate market.
So of course, when we do leverage, so if you do full cash payment, $2 million, if you end up with 400K in terms of appreciation, there is about a 20% return on your money. But when you leverage, actually, you get 4 times the amount of return, and that's why it will bump up to 80% because you are using 500,000 to actually have the appreciation of 400K.
Yeah, so on a cash-on-cash return basis, this is actually an 80% appreciation and return on your initial investment. So of course, there's a little bit of advertisement timing. So if for those of you who want to have some free tools, you can actually head on to the App Store to download our PropertyLimBrothers Nucleus app. This will give you actually 4 different kind of calculation so-called like tools for you to play around with. Of course, one very commonly used tool will be mortgage loan. Of course, you can also look at other tools, TDSR, MSR calculation. And some tools are only available from our PLB Inside Sales Team consultants. If you need very detailed tools like timeline kind of tool to chart out and plan your sell and purchase kind of timeline, do contact some of our consultants with the numbers right down below. So this is an illustration of that example. Let's say you were to purchase something at $2 million, 3.5% SORA rate. And let's say, for example, if you're 40 years old, you can leverage 25 years more. Just take 65 minus 40, 75% loan, 1.5 million. Your monthly installment is 7,509. And the calculator also shows you the breakdown in terms of interest and principal. So the second theory is that basically, when you look at this entire amount, if this is a property that is meant for investment or rental, most importantly is that this is the interest that the bank is interested in. This is actually paying down your initial loan of 1.5 million gradually. And as long as, of course, one side of the story is that if you can actually get a rental to cover the entire sum, that would be fantastic. But in the real life scenario, because Singapore is already progressively moving towards like the Hong Kong status in the sense that a lot of our rental rates cannot fully cover our mortgage. But most importantly is that if your rental can cover majority of the interest plus a bit more of the principal, you have technically already gained from the investment in the sense that your tenant is the main person paying down the interest for you. And you are the person that is building up the principal towards your property. You got something to share? Yes. Yeah.
So on this part is because just now we mentioned about that 80% return on money. And most of the time clients will ask, hey, but I actually pay an interest to the bank when I'm doing a leverage. And what we're trying to say over here is that the tenant is the one that is going to pay off all your interest, and hence you're actually getting the full 80% in terms of the return of your money. And on top, you can treat principal as part of your savings plan. Something that is very interesting for mortgages is because it is like a reducing mortgage loan. So every single time, every single month, when you pay down a monthly installment, the next month's interest will actually get lower. And of course, currently in the shorter term, where we are still considered at a higher rate, interest rate environment, now 3.3% for fixed rates. But we are also seeing and projecting that in 1 year's time, Fed rates will start cutting their rates, and we could normalize in terms of Singapore interest rate back to somewhere around 2.5%. And then you will see your interest element paying per month will also be driven down significantly, and then more of that will go into your principal payment, building out equity even faster.
Right. So this is basically to illustrate the portion that leveraging is actually a tool and a benefit. And of course, every round when we have cooling measures, when your LTV is being affected and you can only leverage lesser from the bank, you actually lose more opportunities. Now, of course, with the latest cooling measure, you have seen a lot of audit news that has popped up, like shophouse sales has climbed after ABSE hikes. Rents for condos and rental continue to rise. More units, more transactions has happened. Resale condo prices were flat, volume down by about 20%. And then HB prices rose modestly. Of course, a lot of this news. Now, this is very interesting because this is the part that I think a lot of people were very concerned about, saying that, you know, private home price has started to dip and drop already, and everybody is waiting for Q3 results to see what's going to happen in Q3, followed by Q4. So I think importantly, when you look at this particular segment, what is interesting to note that there was one segment that actually seen a dip, which is minus 2.5 in the RCR region. So actually, we got our research team to come up with this chart. Of course, we mark the entire portion. This was actually the light green color line is basically RCR non-landed. So if you notice, OCR has a small rise in terms of percentage, CCR as well, and also landed property, which actually rose. Plus, of course, overall, because of the fact that RCR has came down by about 2.6%, it brought the entire index down by 0.2%. So of course, what's going to happen is that this will then translate to Q3 results, where we want to see what will be the ongoing movement. Of course, if you were to continue with the news, you will also see that fewer units were sold for 5 straight quarters in terms of the condo resale kind of movement. Core inflation rate surprisingly has came down, and later we're going to talk about this because this will then relate and correlate to the fact that what is going to happen when inflation comes down globally, especially in US and also in Singapore. If US Fed starts to reduce and so-called like pivot and bring their rates down, what's going to happen globally to our global mortgage rates? This was a very interesting article that came out. Fewer foreigners bought condos. Later, we're going to dive into some of our charts. So basically, it's to show you that after ABSD has came out, there were a lot of interesting news that propped up as well. And for those of you who are joining us for the first time, my name is Melvin. I'm the CEO and co-founder of PropertyLimBrothers. And with me will be our senior investment consultant, Rong. And of course, this is our entire team. I think that if you have already seen our videos, you are here, you probably know what we do as a team, and we're all very passionate in real estate. We want to deliver great content for everybody. And of course, all our webinars are unbiased in the sense that if in the event you've come for any of our webinars, as long as you see topic headlines like this, these are purely from our research team, and there's no product push at the back. That means it's not going to skew down to saying that, hey, you should go for this new launch, you should go for this project launch. In the event, if we were to partner with any developers, we will put the title of the project at the start of the webinar so that you are aware that, okay, this webinar, we're going to feature this particular launch. This to ensure that even we ourselves, when we talk about certain things, we go with frameworks and methodology and not really to push a particular type of property. We're also going to have this 15 September event. This is going to be like a live debate session that we'll be holding. And we're going to talk about this very interesting topic. So we're going to have, first of all, is it a BTO versus resale, HDB versus EC versus condos. Yeah, so there'll be 4 people that will be debating, taking a position on 4 different types of properties. I'll be the moderator. We're going to do it live on 15 September. More details will be released soon. Please sign up for the event and watch that live debate. Last but not least, let's kickstart today's segment. So what is the relationship between cooling measures and price performance in the real estate market since April? Let me hand over to you, Rong.
Okay, so over here, first chart that we are seeing is what you have always been showing you, which we show 3 price indexes. The yellow one is the landed property price index. The red one represents your condo apartment price index, as well as the blue one represents HDB pricing index. And every dot that you see over here represents one of these cooling measures. And so far, we have about 15 rounds of cooling measures. Broad-based wise, the types of cooling measures that were implemented, number 1, either when somebody wants to purchase their secondary property, they have to pay an additional buyer stamp duty that is trying to basically curb investment demand so that we can protect the first-time owners. Second one is where we try to reduce the number of loans that one can get by reducing what we call the loan to value, which means that there is more down payment that is required. Third is through controlling how loans are going to be borrowed and assessed by borrowers, and we call that the total debt servicing ratio. And how we actually use this, which is the godfather of cooling measures, is number 1. We use a stress test rate previously started at 3.5%, meaning that when the market interest rate is only at about 1%, we are lending based on 3.5% in preparation that in case interest rates goes up, most of the borrowers can still continue their monthly installments, and hence we do not have a fire sale situation. And lastly, one of the very interesting cooling measures which is very, very effective is your seller stamp duty. All in all, it gets rid of speculators in the market, because if you are trying to come in for like a short-term flip and gain, we discourage that by having the sellers to pay stamp duty based on if they were to sell too early. But what's most important, we just want to cover the 2 main most recent ones in April this year, doubling of ABSD. So foreigners now, ABSD, they have to pay 60%. That is the highest in the entire world. And secondly is with the 15-month wait-out period, if you are selling a condo and want to come back to buy a HDB, in the midst of trying to make sure that we protect HDB price growth. So we can first delve in for the last 17 months of Singapore residential transfers. Okay, so over here, the last 17 months of HDB price index, something that is very interesting is, of course, price trend continues to grow, but you can see in terms of volume-wise, it has came down in June and July. But this doesn't mean that there is any weakness in the HDB market, but more because actually HDB implemented this new process called the HFE. And because now, with HFE, then you are able to go into an option to purchase to buy a HDB. But the processing time of HFE now is at a backlog, because whether you are buying a BTO, buying a resale flat, whether you want to take a loan, not take a loan, buy in full cash, you have to go through this HFE process. And because the processing time is so long, that's why you see the volume of transaction dip. Last year in June was about 2135. This year in June was 1856. And same thing happens in July as well. So that is the more significant dip in volume.
You're on good point on the HFV. I think what's going to happen is that once because there's a lot of technical error, right, on the HDB side,
Yes.
as they're trying to implement this new system, which I think is good because it talks about everything that you qualify for, grants and
It is super good and super accurate because before you commit to any purchase, you already have certainty on how much grant you can take. Whether if this is your second HDB loan, they even tell you how much you need to
right size, put in the cash from your previous cash proceed, all that kind of stuff, so that there's no confusion, right?
Yes.
Compared to the old HLE system. But I think what's going to happen in the month of August and September is that
the volume of transactions
the transactions will explode because a lot of people are waiting for the HFE approval
to execute.
And the amount of resale net applications, I think, is like really at a high backlog stage. Of course, we don't have the numbers. This is just based on what we're seeing on the ground because we have a lot of properties that the buyers are keen in, but they're all saying that HFB is stuck.
Yes, and this is also because like September, there's going to be a major BTO launch as well. So hence, like the processing time now, it is like a critical juncture.
Right.
Okay, next, of course, we have the private non-landlord, which is our condos and apartments. And of course, you can see that usually blue bar shows the volume, and this is very normal to have like what we call like an inverted U shape, because now we have reverted back to pre-pandemic situation where usually people start to travel December, January, February, so you have lower volume of transactions. Quarter 2, quarter 3, you usually have the highest number of transactions.
Yeah.
Pricing has overall been quite stable as well.
So usually these are the traveling months. So that's why you see that dip in volume. So this is back to like pre-COVID season. And of course, over here, it'll be like the CNY season. So usually people will start to transact very heavily from March all the way to September. That's the usual season pre-COVID.
And something that is very interesting observation is because I think after practicing real estate for last 10, 11 years, clients always mention that ghost month, nobody want to buy houses. But actually, July, August is still one of the highest transacted in terms of volume-wise. So this is definitely a myth. Going to the landed property, you see a similar behavior. Pricing is still going up. We are still having pretty similar transaction volume as compared to last year. A little bit lesser, but pretty consistent. Basically, the blue bar shows the 99-year leasehold transactions, and freehold 999 represents the green bar. And why we see more freehold getting transacted is because there are more freehold 999 landed properties as compared to 99 years landed property. We can also see that for strata landed transactions, which basically is like a landed form in a condo setting where you have security. And something that is very interesting is usually when you see there is a major jump in terms of volume of transactions, that is because there is a new launch, and there is 11 at Holland that Melvin just written on the board.
This was the 99 strata that came out, and it was basically like a one-off kind of sale, and a lot of people were very interested. So there was this propped up in terms of, and of course, these are all the 99-year properties that was being done, 11 at Holland.
Lastly, of course, we can talk about condo rental transactions, and we all know that the red line actually represents the price growth. So last year, there was a 30% jump for the last 12 months of rental pricing. And this year, we are going to see this growth rate taper off because we have 19,000 of TOP condos that will collect their keys. So what it means is some of these rentals who are locals, they are going to collect their keys for their HDB or their condos. They no longer have to rent anymore. So this demand will disappear from the market. Second thing is when there are new key collection, it also means that there are new supply that will be introduced to the market for renters to look at. And most of them, I would say that 1 and 2 bedders will see a sharper spike in terms of the availability. So if you are like a rental looking at a 1 and 2 bedder, then you might have better finds this coming year ahead. If you are a landlord, then you have to prepare that. Of course, number one, you are not going to expect the same kind of price growth rather than trying to wait for the additional $200 in terms of rental transactions. If you get a good tenant profile, it's better to get the rental started, lock it in 2 years' time. And so it helps you to reduce the amount of vacancy and opportunity costs from vacancy.
Yeah, so just some quick tips for existing landlords. So if you have already have a good relationship with an existing tenant, what's going to happen, like what Rong mentioned, is that there's two things that will happen in the market in the next 12 to 24 months. Because of the fact that there's 19,000 TOP projects, right, Rong, you're mentioning. Our own forecast is that, of course, a lot of people that have been into the new launches about 3 to 4 years ago So, for example, most of these TOP projects, for example, like Park Esta, Riverfront Residences,
Florence Residence,
Florence
all the mega
Residences,
projects, Momentum Park.
yeah, 2023, and we're talking about like 2019. What's going to happen is that they are going to move into these properties, and they might be either living with the parents, as in the owners of these new properties, they are either living with the parents or they are actually renting. So, because they are renting, and when they move in, these units will be free up in the overall rental market. And of course, over here, maybe some people, I'm not sure how many percent, but let's just take, for example, maybe 20% of them bought for rental investment. This is also going to add into the pool in the rental market. So what's going to happen is that if you're an existing landlord, it might be wise for you to negotiate a fair renewal rate with an existing tenant, because if you were to just lose 2 months of vacancy while hunting for a new tenant, that's already 2 months off your total rental yield. So it might be good to discuss a little bit, if renew at the same rate, maybe just to increase a little bit, or maybe you might want to see how to have a win-win situation, maintain your relationship so that you don't have vacancy period. If you are a tenant, then you might need to take note that, okay, because there's fresh supply coming in, there's a little bit more choices for you to hunt for.
This reminds me a little bit back in, I think, 2016 or 2017, where renters only want to go for 1 year lease because every single month there is a new TOP project that introduced plenty of supply, and every year the rental rates were dropping then.
Right.
And so like renters always, they don't want to lock in because they know I can stay somewhere that is new, yet at
choice.
a lower rate. Yeah. But of course, I'm not saying that we'll be going back to that situation, because we are going to still open up our borders and invite more foreigners to come in to work. So some, of course, of all this supply will be taken care of by this demand from an influx of a new workforce.
Yes.
Interestingly, we also have landed rental index as well. So landed rental index most of the time is, nowadays we also see a lot more interest in terms of landed properties. Rationale is because sometimes when new condos rental rate has been going up so high, 6,000 plus for like a 3-bedder, and if you were to top up a little bit, you are able to stay in a much bigger floor space in landed property. Of course, there are no condos, but for people who prefer to have more space, that's where actually landed property, in terms of popularity, rental-wise, has also come into place over the last 2 years or so. Lastly, I want to talk about something that's very interesting, because we have 11 rounds of central bank US rate hikes. And from last year, start of last year was about 1% in terms of mortgage interest rate in Singapore. And the floating rate now is about 4.2%. So because monthly installment, so interest rate has went up by 4 times. But what we want to observe and share with the audience is that your monthly installment do not increase by 4 times. It actually increased by about 40% if you are taking a 30-year loan, when your monthly interest rate actually 4x. But what's the interesting observation? Most of the time when people's consideration is when interest rate goes up, they are expecting that price should come down eventually, which we see in a lot of markets. For example, Hong Kong, we also see UK property prices start to come down, US as well. But we want to see the correlation between interest rates as well as our charts in Singapore is, we can look at the price index. Red color, dark blue color, as well as light green color, they represent landed condos and HDB price index. And we can first look at the yellow line, which is the central bank interest rate. So every time you can see that when there is an interest rate hike, actually what you see is that property prices go up instead. So we have like a reverse correlation as compared to other countries.
Yep. So I think it's already the 7th to 8th round that this is happening, and the only round that there was a right correlation in terms of what is happening in the global regions, because by right, if let's say interest rate were to go up, price should come down because the purchasing power of buyers has dipped. But the only time that it has happened was actually way back in 1996, 1997 during the Asia financial crisis. That's the only time when interest rates propped up, price came down. And the rationale and reason is because back then, there was almost zero cooling measures. But this time around, we have 15 to 16 rounds of cooling measures ever since 2009. So I would say that this phenomenon very likely happened because of the fact that we have all these cooling measures that we are stuck. And our government is not going to release anything until they see very clear signal And what do I mean by that is that because right now it don't remove anything. If you were to notice, why is it that from the past 16 years, is it 16? 2009 until 14 years. 14 years. Why is it that there's no discussion about removal of any cooling measures? The key rationale is that the moment any one of these cooling measures are being released, just imagine if let's say tomorrow, government came out with an article and said, hey, okay, on this particular day, we're going to revert from 60% ABSD for foreigners back to 30%. What's going to happen is that the floodgates are going to open back and foreigners are going to come back in to buy more residential properties. And of course, if you have been with us for the last rounds later, we'll just do a very quick recap, is that one of the key rationale for this doubling effect of ABSD was the fact that there was an increased percentage of foreign buyers buying OCR properties.
Now, I think there's something interesting about cooling measures as well, is that cooling measures are not meant to crash the market. It is meant to make sure that we are going to have stable growth, to make sure that no bubble is going to build up, such that you also make sure that prices can remain as affordable as possible. And why cooling measures are not being removed is because the interest and demand is still very strong. Imagine if any additional buyer stamp duty is removed, the demand will immediately spike up the next day. So you can think of it in that sense, in the worst case scenario, where really there is a major correction, the government can always release some of these cooling measures that has been implemented to spur demand back into the market again. And if, as long as you have the holding power to ensure that you do not need to sell when the prices are unfavorable, then you are actually in a very good and safe position. Launches.
All right. Let's talk about launches. So at the start of the year, we came out with one of the webinars talking about the fact that there are 47 new launches this year, a couple of which are boutique developments from all the on-block projects. And of course, we also talk about the fact that above 500 units, there's only a very limited number. So these are the Jan to August new launch performance results. Of course, I think what has been some of the highlights was recently on Grand Diamond, that you can see that in terms of performance-wise, they did quite well. I also have sort of like have this sensing on this trend that's happening on the ground. I think nowadays home buyers are getting, of course, very well informed, savvy. There's of course a lot of research articles. There's a lot of content online, and I think there's sort of like a more uncoordinated movement that home buyers tend to now deviate towards like larger developments. And I also think that is probably because of the fact that a lot of the larger land plots, they enjoy more proximity to MRT stations because of the fact that is also based on GLS land sale. And with the larger developments, I think basing off all the trends for all the cooling measures, everybody now is holding on to their first property as a very, I think, important decision. In the past, before more cooling measures were being introduced, the trending was that people would tend to sell a property, buy 2-3 properties because there was very little, almost no ABSD. Nowadays, because that the second property ABSD is now 20%, and bearing the fact that prices has already propped up, I think couples and families, they are now having the mindset that, okay, our first property, it has to be in a place with a lot of facilities for our kids. It has to be in a place that, minimum we want a 3 or 4 bedder. We want to have a little bit more space. And thus, I think there is like an uncoordinated movement towards larger developments with more units in the project. Because more units also coincide with the fact that the land is bigger. There's more facilities. Yeah, so what do you think about this, Rong?
I think personally, a lot of times when a lot of buyers, they will think that when there is an influx of supply that comes in, it means that prices are going to dip. And if I'm a buyer myself, I love having supply. For example, if you are back in 2022, when new launch supply is very, very limited, you realize that every time the first day of sale, they sell 70 to 90%. I think the highest was 97% for Amor residences. And so what happens is when you have a lot of new launches, number one, the developers have to price their products more sensitively because they know that buyers have more options. And second thing, as a buyer, now I know that because there are more options, it's easier for me to discover gems. So when there is a huge supply, actually, it is the highest chance for a potential buyer or investor to find the best buy. And during launch day, you have lesser competition. And we are, of course, expecting that percentage of sales launches, maybe in the coming ones, to actually taper down.
Yeah. I think looking at this, and of course looking at some of the news, for example, I mean recently, I think if you have seen the news, for example, there was a project called TMW Maxwell, right? I think sometimes when you see news like this, or maybe you see that, hey, you know, percentage of units sold on launch day, 29%, and maybe you are looking at like TMW Maxwell selling a certain number of units on their launch day as well. But something to note is that TMW Maxwell is not subjected to the 5 years ABSD ruling. And some of the developments, basically, even though they are subjected to the 5 years ABSD ruling, meaning that if let's say the developers do not sell off all the units within the 5 years mark, they will have to incur ABSD. But I think there is some structure in place in the sense that if you were to look at how developers have done it and performed over the last previous round, most of the time, I think as a consumer, you might be hoping that, hey, will they start to reduce price? But from a developer's standpoint, the moment they start to go towards their strategy, as in, for example, they have sold off 200, 187, 340 units at launch day, if they start to reduce price, what is going to happen is that they're going to damage their own reputation. And most of the time, developers, based on their trending and based on what we've observed, is that they will hold their price because they want to be fair to the first group of buyers that bought in. And if let's say they will have to hit like 30, 40, 50%, they already has hit a certain percentage as a benchmark, and they can just gradually sell and take the next 2, 3, 4 years to sell in the market. And that was actually what happened for Sterling residences, riverfront residences, foreign residences, where once they hit a certain percentage, they would just continue to place it in the market. And of course, that gives you a chance as well as a consumer to take your time to select, to take your time to exit from your current market also. So sometimes what I'm trying to summarize here is that when we see such news, all the more it adds into their mindset that, hey, maybe I need to time the market now. Let me just wait and hope that price will come down. But sometimes the reverse happen. For example, in the previous season, when you look at, I don't know whether Florence or Riverfront, did they increase price towards the end? But maybe you can share a little bit.
Generally, in observation-wise, for a lot of projects that they have launched their price correctly, what the developers do is like a staggered version of price increase. So when they hit a certain number of percentage of sales, they might adjust all the remaining units to increase by maybe 1%, etc. Recently, we also see some of the projects, like for example, Grand Diamond just had a price increase. But of course, they did not increase like your 4 and 5 bedrooms because the number of percentage of units sold for the 4 and 5 bedrooms are not that significant at the moment. But for the rest, they are performing well, 1, 2, 3 bedders, they are all increasing in pricing. Yeah. And we also seen some projects before where when developers launch maybe at a much higher pricing benchmark, and in order to boost sales later on, they might do other form of promotions, which allow the second wave of buyers to actually come in at a slightly lower pricing than the first ones. So usually, that's why it's important to make sure that we do the correct analysis to make sure we understand how much profit margin the developers are actually having, what is our disparity effect within the development as well as to surrounding districts and region, to make sure that we are identifying the correct project unit type as well as the right entry price to enter in order to safeguard our downside.
Yeah, so of course, what you just mentioned was that there could be promotions, for example, like star buys that happen. It has happened before. And usually star buys is basically like if the developer were to relaunch, they want to boost the sale, they want to hype up the project again. It might happen, but it might not necessarily mean that there'll be a drastic drop in terms of price from the first launch because they also need to protect their reputation. What we're trying to say as well, one last thing before we move on, is that not all launches can buy, because we're not trying to promote the fact that only buy new launches. Because if you have came to our content before, you look at our banter, you look at our webinars, the methodology that PLB have in terms of our selection framework for residential properties is that it is project-based, it is disparity effect method base. It is basically looking at the certain type of product, certain type of condos. Is not based on whether is it a clear-cut resale or new launch. So we don't advocate the fact that new launch, you will sure see appreciation, because sometimes if you select the wrong type of new launches, you select the wrong type of projects with the wrong kind of fundamentals, and maybe the pricing is not so-called like launch at the correct season right now, you might not see appreciation for a good 10 years, and that has happened many times before. Certain resale, you will see appreciation faster than new launches. Certain resale, you also see stagnation. So it's not really about new or resale, it's really about the selection criteria. So let's move on. So I think it's very important to look at this portion right now, because this, of course, came as a concern. But I think when we understand the rationale for this, then we will understand whether will there be a price dip in certain kind of properties due to this ABSD. Now, this was, of course, evolved from the fact that a lot of foreign buyers, even with 30% ABSD, they still come in and buy. For the very fact that Singapore is a safe haven, we have strong currency. However, why is it that even though year on year, the percentage of all kinds of residential transactions by foreign investors is only ranging from 4 to 6%, why is there still a need to double up the ABSD to 60%? And this is the first time government has doubled up. Most of the time, they would just increase by 5-10%. But this is the time they really multiply by 2 times, 30 times 2 to 60%. The very rationale is for the very fact that in terms of what is happening in the mass market region, there is an increase in the amount of foreign interest in OCR developments. And I think it's because of this rationale that our government decided to take like a massive step so that they can curb the demand in mass market regions. Because mass market regions, that's the region where a lot of HDB estates are, a lot of aspiration by Singaporeans to upgrade from their HDB properties to private properties. But if there's a lot of competition here from foreign buyers, then I think that is something that our government do not want it to happen. A very interesting point here to note. So, of course, there's something that might happen, and this is my own personal forecast. So I need to put a disclaimer, this is my own personal forecast. What is going to happen is that, actually, Rong was the one that has done this comparison chart. So based on, let's say, for example, if let's say you were to be a foreign buyer that's very keen in buying something in Singapore, you want to settle down here, you want to own a residential property, or maybe you just want to treat Singapore as a safe haven to own a real estate right here. The actual budget that somebody might have is at the first row. So it can range from 2, 3, 4, 5, 6 million all the way to 20 million. And of course, in the past, with 30% ABSD, somebody with $5 million can only buy $3.7 million worth of the property in terms of its valuation, because they have to factor in 30% for ABSD, 4% for buyer's stamp duty. Right now, this budget is reduced further to 3 million because they have to allocate another 700,000 for the additional 60% ABSD in totality. So from 5 million, actually, they're still paying 5 million, but on paper, they can only buy something that is $3 million. So this is the impact that has happened. And of course, somebody with $8 million total budget, on paper, they can only buy something at 4.8 million because the rest has to be allocated for ABSD and BSD. They are still paying 8 million, but they can only buy something that is valued at 4.8 million. So what is going to happen is that in the past, a lot of CCR properties, I think a lot of buyers also, or maybe Singaporean buyers or PR buyers, they enter CCR properties with the mindset that, hey, in future, if I want to exit maybe 5-10 years later, I will have an audience pool that is from foreign investors or foreign buyers that want to live in District 9, 10, 11, CCR, downtown core region. But this is something for you to take note. I'm not saying that it will definitely happen, but what might happen is that this buyer audience might start to shrink. Of course, if the government were to release that ABSD measure, then the demand from foreign interest will come back. But I think in the next couple of years, as long as all these cooling measures stays, foreign investors, because of a reduction in budget, might hunt for properties with a reduced range. They might go into RCR area, or they might still bite the bullet and go to OCR area, or they might buy smaller properties in CCR area, or they might even avoid Singapore altogether. So this means that if you want to buy CCR properties, you have to put on like a more focal point in terms of the overall quantum that you're entering to make sure that when you exit, you don't have an issue finding the next buyer that can absorb your property.
And so I think what is important is for core central region properties is to identify to get into properties that locals will still have high demand, so that we are not banking on foreigners as the main exit audience. And of course, from the on-the-ground interaction with the high net worths, what I realized is actually ultra high net worths, I think they are still not too concerned about this 60% ABSD, and that is why we didn't see foreigner purchases drop all the way to 0%. However, in terms of the on the high net worth setting, they might consider a new strategy where they might come in to have an employment pass first, rent for 2 years while they strategize to get their permanent residence, then they start to own their property. And for the ultra high net worth, if they are buying core central region, then they are usually looking for luxury buildings, big floor plate, usually more iconic space, bigger land size, freehold properties. And these are some of the developments that we see those 2 to 3 million or $4 million of a profit margin.
All right, let's move on. So basically, in summary, is to limit your ABSD risk by buying properties that locals want and can afford, especially if, let's say, you have a plan that you want to exit in 3-5 years' time. You have to take into consideration the possibility that this 60% ABSD, let's say, is still in place 5 years later. You want to make sure you have a ready exit audience. So let's have a look at the second portion of the charts. Rong, take it away.
So over here, I think when we implemented on 27th of April, the new ABSD rate, of course, we can see that in May, the volume of transactions have sort of like reduced by almost 40% from 114 to 67. And largely, I think in the May transaction data, some of these people have already, who have clocked under the 67 volume, probably did not need to pay the 60% additional buyer stamp duty, because this ruling is actually based on when the option to purchase has been issued. So as long as the OTP was issued before 27th April, even if they exercise in May, they will not need to pay the new ABSD rate. But if you can see the numbers in June and July, basically we're looking at the blue color line. Now this, I would say that it reflects proper transaction with the new ABSD rate at 29 transactions for June and 32 transactions for July and for foreigners. So next on, let's look at some charts where we look at the last 23 years trending in terms of volume and price transactions. And over here, what we're trying to showcase to you is the number of volume of non-landed condo and apartments volume. And every time you can see that why in 06, 07, when our prices went up, is where there's a significant volume of transactions that came in. And what's interesting is over here, you can see that foreigners and companies start to come in to buy aggressively in 06 and 07, pushing up the speculative in prices. And when the global financial crisis come, volume have dropped by almost dropped by 2/3. And hence you can see that prices have came down. Eventually, when prices start to pick up again because of quantitative easing, when total debt servicing ratio was implemented in 2013, and that is where you see in terms of volume of transactions has cut by 50% over the next 1 year, and that's where we see our price index actually taper off in the next 4 years region. So generally what we're trying to say over here is previously, why did price, there's a change? It's because why there's a price change when the last peak in 2013 all the way until 2017 is because the total debt servicing ratio has reduced the amount of people that can partake in terms of property investments in Singapore. And when the new volume is created at a lower volume, there is a new price equilibrium that needs to be reached before the prices can start growing again. So if we were to take a look at the breakdown in terms of percentage of transactions, over here we can see that previously there was an era when before ABSD was implemented, there was strong participation of owning residential properties in company, which is the grey bar, as well as in green, which is foreigners. And after ABSD started implementation in about 2011, we see that the amount of foreigners start to reduce. And recently in 2017 and 2018, as well as 2022, we start to see a new influx of more percentage of properties owned under companies. And that's where we see articles where there are family offices that are being set up to own all of these asset classes to help them grow their asset portfolio. But something that is very, very good and stable is if you were to look at the trend. So you can see over in the last 5 years from 2019, what makes the property market so stable is because most of the transaction, about 94 to 95%, are being done by Singaporeans as well as PRs.
I think when we look at all these charts, the main objective is, of course, we want to derive if there are certain trendings that we can forecast, because a lot of these charts are actually based on past and current data. But what's very important is that we want to know, in terms of forward looking, what might happen in the next 4 quarters. And I think that's what property buyer is very interested in. However, sometimes I think there's also like a lot of analysis paralysis, in the sense that because let's say if let's say you have been waiting on the sidelines, sometimes there could be like analysis anxiety, in the sense that when you keep looking at too many data points, too many charts, and then you're trying to so-called like hope that there is like a price dip, and then if it eventually doesn't happen, and you get priced out of the market and you re-enter at a higher price, that is what we all want to avoid. So I think most importantly is that when we come to one of our PRB webinars, you will realize that we always like to talk about macro, and then we zoom in on micro. But eventually, I think the core few frameworks that we always want to advocate is that if this is your primary property, like what Rong mentioned, 94% are being done by Singaporeans and PR. This just shows that a lot of all these properties are transacted without the influence of foreign investors' liquidity. And the motivation behind the fact that Singaporeans and PRs are buying, firstly, it could be all their first property or second property. It could be a couple that are dual income families buying 2 properties, one for rental, one for own stay. It could also be the fact that they are buying a property because they want to be near a children's school, near parents' place, near their workplace. It is for primary usage and consumption. That means that the motivation to sell it at a fire sale price is very low. And we always have to note that when price drop, there are 2 things that must happen. Number 1, developers cut price drastically. Number 2, resale sellers cut price drastically.
Anymore,
yes,
due to not being able to afford their monthly installment, for example.
Or it's because of over speculation. They own a lot of multiple properties. There's nobody renting and sustaining the monthly installment. But for the very fact that rental is at an all-time high, there's still a lot of rental demand. Foreigners are coming into work. There's a lot of demand from in terms of like manpower supply and things like that. And for the very fact that most people buy for own usage, so the motivation to hold it is very, very high. And of course, that will bring us to the blackout period as well. So maybe let me just switch very quickly to this part here. So we have a lot of charts, oh my goodness. Okay, so the blackout period is something that has been created from this particular cooling measures, which was the 3 years SSD. This is actually based off a Morgan Stanley report, in the sense that after the SSD has been introduced, sellers have an average holding period in Singapore of about 9 years. And when you look at 9 years, it means that their motivation to hold this property is very high. It could be because of the fact that maybe this family has 2 to 3 children. One child enters a primary school. The next child has priority to enter. The next sibling has priority to enter. Primary school journey is 6 years. Some of our clients, they buy properties near to Mary Stella at Bartley, for example, near to PRMGS, for example. Their children study with affiliation. Primary school, secondary school, that's easily 10 years. And that could be the core rationale that Singaporeans or maybe PRs, they have a high level of holding period. And in terms of homeowners avoiding selling within the first 3 years, it is very, very high percentage, because nobody wants to be taxed the seller stamp duty for no reason. So everybody now enters and buy a private property with a few key intent. Number 1, I must have 25% down payment. I must be able to pay 4% buyer stamp duty, that's 29%. I must be able to pay my installment for the next 3 years, because I don't want to pay seller stamp duty. And of course, a lot of them buy for the intent to stay and enjoy the property. Thus, it's very hard to find fire sale in the market, because if you just go to any portals, it's almost impossible to find like a fire sale in the market, because everybody is using their property. There you go. Something to...
Looking at easily affordable entry price property for each segment, these are not easily, you can't find it easily, because whenever there is a slight discount, it will be grabbed up by your competitors.
Yeah.
But if you're looking about like fire sale in like certain areas where they are like luxury apartments, then they might have some form of percentage of discount because they have to exit their funds from Singapore. And but is this the kind of properties that you are looking for to actually include in your portfolio? Yeah. So showing you this article, it actually mentions that there's a 0.4% dip in Q2, but this is from the flash estimate. But of course, when the actual data is being released, we realize that the actual dip is actually at 0.2%. So the first question I want to know is, are we at the end of this 3-year bull run? Because the last 3 years has been extremely exciting because there's 25.1% in terms of price index increase for non-landed homes. And we have done a study for all 2,330 condos and apartments in Singapore, and we want to rank from this bell curve. How many of these projects actually have better profitability than the index? And are there any projects that were unprofitable? And so if you can see in this area that actually there were 47 projects that was unprofitable in the last 3 years while there is a bull run. And the biggest loss in terms of PSF decrease was actually 25%. And something that is very interesting, if we were to break it down in terms of the different regions, is in the next slide, you realize that when we look at this data, the arrow actually shows the median price growth that respect to the price index. Anything that is on the right shows that it outperformed, anything on the left shows that it underperformed, and we can see that core central region has the most properties that underperformed the overall price index over the last 3 years. And one of the strongest gains in terms of probability, of course, you can see that they're in the eastern region as well as in the northeastern region. And if we were to just dive into if we were to just look at the price index, so this was the all residential price index that we saw a 0.2% decrease. But when we look at the different segments of landed and non-landed properties, this is not the first time that red color actually means that for this quarter, the price index is slightly lower than the previous quarter. So in the last 3 years of bull run, we have already experienced multiple times that it is very normal to not have every quarter to be increasing when we look at some smaller segments in the market. And what is important is we want to showcase that is there a possibility that we are able to profit only when the price index is going up. So in this scenario, project A, 3 bedrooms, these owners all bought in 2019 just before the bull run, and they sold in 2022 in a 3 years holding time span. You can see that their gross profit ranging from 300 plus thousand to 400 plus $1,000. And what is interesting is for these people, their down payment is only 25% plus 4% buyer's stamp duty. And so they almost make 80% of the money that they put in over here. So you can see that they range from about 70% to 90%, meaning that with the capital of, for example, this person put in a capital of 465,000. His gross profit was 433,000 over 3 years' time, which gives them a compound return on their money at about 23%. So of course, we can attribute this to because that this is a bull run. But what I want to answer is also, is there a possibility that when the price is coming down, and if I were to buy a property at almost at the peak or the peak of the market, will I actually be able to get any form of gain, or will I actually lose? Will I actually make a loss? So you can see it in the case study of Project B. Entry timing is in 2014, which is just at taper off the last peak, and we sell in 2018, 4 years holding period. And why 4 years previously was because seller stamp duty at that juncture was a 4-year holding period. You can see that they are still getting a gross profit of 200 plus thousand to 300 plus $1,000, mapping their capital outlay. And what is interesting is previously, because down payment was only 20% and 3% buyer's stamp duty, so the capital outlay is slightly lesser, and the amount of return on equity is higher because now the holding period is 4 years. But in short, if at a correct project selection, it actually beats timing the market. Because as long as we are able to identify the correct project, identify the correct unit at the right entry price, we are able to outperform the market and make sure that we don't need to wait for an overall dip to actually be profitable. So how can we position our portfolio for success? And we can actually look at how SG real estate performance versus other form of asset classes. So we have done a comparison between S&P 500 comparing US stocks, STI to represent Singapore stock market, Bitcoin to represent the cryptocurrency market, and we can focus on all residential, which is actually where our private landed and non-landed apartments are. One thing to note from this graph is we can understand that in terms of global financial crisis, all the other markets actually have very strong volatility of about 30% price drop. But in Singapore, why we don't see any form of price drop is because of the bedrock of cooling measures that we have implemented to ensure that there is strong holding power of homeowners. They are able to afford their monthly installments. They have high equity in their homes. And that is why you have a very stable asset class. Next will be, of course, we can see that in 2021, 2022, 2020, 2021 was a very strong bull run for all asset classes because in 2020 there was a large amount of money that was being printed. And you can see in terms of S&P 500 index, it went up by almost 29%. And we had relatively good performances in the real estate space. All residential actually went up by 10.6%. And in 2022, when interest rate go up, we can start to see all these higher volatility asset classes actually lost quite a bit of the gains that was being generated in 2021. So Bitcoin erased all of the gains in 2021 as well. But in the Singapore real estate space, we are still actually growing at a very steady rate at 8.6%. And so what we are trying to share over here is that like, if you're looking for asset class that has protection towards downward volatility during global financial crisis, and you want to have a stable growth trend, then Singapore residential real estate is definitely an asset class that you can strongly consider to be a main part of your portfolio. And this is performance where we look at what we call without leverage, meaning that this is growth rate without having taking any form of loan. So you can see if I were to take a loan, then all the returns on a yearly basis can actually be 4x. So let's look a look at this scenario. 3.8% increase in the property price will mean that your money grew at 15.2%. And so when you look at the leverage numbers, it is very comparable to other form of asset classes. We are not trying to say that in the next 3 years, we can experience like 42%, 53% in terms of like how your money will be growing. Let's take it from a very conservative standpoint that the property value only got up by about 3.8%, which means that 4x 15.2% a year. We want to answer the question, how fast will your money actually double? And the answer will be, your money can double in 4.8 years as long as there is a 15% per year increase with leverage. And why we love that is because real estate eats inflation for breakfast. And whether land price increase, construction cost increase, it is essential for real estate prices to actually follow suit. That's why you can eat real estate for breakfast. And we also love that inflation helps to erode your debt. And that is why it is perfectly fine to take on good debt in real estate. Reason is because, for example, today, $10. How many packs of chicken rice can I buy, Melvin? 2.5 packets, right? And if in 20 years' time, based on a 3% inflation rate, the same $10, I can only buy 1.5 packets of chicken rice. So why would I want to pay down my loan so fast? Because if today my monthly installment is $5,000, I would like to pay down my loan slowly because in 20 years' time, I'm still paying $5,000 of loan. But this $5,000 can only buy $2,800 worth of products today. So hence, when I slowly pay down my debt, inflation actually helps to reduce the amount of interest costs that I'm incurring and thereby actually increasing how my money can actually increase in value.
Yeah, so what we were trying to say is that the overall property value increase with inflation because all the materials, construction costs, and of course, liquidity and all this, anything that contributes to an increase in inflation increase the valuation of your property. Which is why you always hear your parents saying that, oh, you know, last time landed property is only like 500,000. I should have bought back then. Now it's like $5 million and all that kind of stuff. But the second principle is that debt is also eroded with inflation because this is the amount that you are leveraging for the bank, but you're paying down the installment with just now, for example, the example that we talked about, $2 million. The installment is at about 7.5. But for the next 25 years, it is around the same amount at about 3% provided, of course, the SORA rate remains around averagely about 3.5%. But you're paying down with an amount that has lower buying power. So this money is going to get gradually smaller over the next 10, 15, 20 years time. So your debt is also being eroded with inflation, which is why it makes sense for you to leverage. And that is why in the whole world, people categorize real estate mortgage as good debt.
Of course, supporting by fundamentals in Singapore, one, of course, income we know that is increasing. But what is also very interesting is that from 2000 as compared to 2023, we can see that overall personal savings rate ratio has climbed from 19% over up to 37.6%. And so means that actually we are more cash rich, and hence, of course, when you have either funds, you'll be thinking, how can you deploy this better? And overall, this also shows that overall in the last 23 years, how our household net worth has increased from 567 billion all the way until $2.6 trillion, and how overall the mortgage loan to net worth has reduced further from 17% back in 2000 all the way until only 9.9% in 2023. So it shows that overall, we are not highly leveraged as a nation, and hence we are overall much more stable as a nation, and that makes sense that in terms of real estate, it's going to have overall continue to have like good overall potential. And because of all these cooling measures and additional buyer stamp duty, the buying behavior has definitely changed a lot. Before all these cooling measures, there is no strategy required. When you have enough money, you just buy additional property. So we have met a lot of multiple property owners where they own a lot of one-bedders and two-bedders. But because of ABSD at the moment, one person can only own one good residential property without incurring any ABSD. And hence, we will start to see that there is a behavior of going to, instead of going for like a one and two bedders, because you can only own one, and the only way for you to increase your portfolio value is to expand through owning a higher value property, which is a bigger property. So there is, we actually see more interest in people buying 3 bedrooms, 4 bedrooms, 5 bedders, as well as landed homes.
Or penthouses as well.
Penthouses as well.
All right, so we are in for the last segment, which is the portion that we think is very important, because I think based on the first two segments that we've talked about, we talked about the market performance since ABSD, we talked about a lot of macro factors, we also talk about the micro behaviors in the Singapore market, even though globally the whole world has been talking about recession for the last 2 to 3 years. But why is it that prices still went up over 2020 to now? Governments still have to put in more cooling measures, which resulted in 16 different rounds. And thus, you have also seen that even though from 2014, because of TDSR, until 2018, our price index actually came down slightly, but there are certain projects that still see appreciation. And of course, during uptrend market, there are projects that seen appreciation, there are projects that have not seen appreciation. We also have talked about certain behaviors of project size, density of projects in our Nuggets on the Go episode called Cracking the Code. You can actually head on to YouTube, key in NOTG, you'll be able to identify the couple of episodes that will talk about certain behaviors on condo density, condo volume and transactions. Now, the last part basically is the framework that we want to introduce to you. This is the framework that can help you in terms of your selection criteria as well as your investment methodology, because you don't have to then time the market and keep thinking about, when will the next price dip happen? Because eventually, of course, if price dip happen, I think everybody will be happy. But price dip happen because there is a fire sale, or because existing resale sellers and developers, as mentioned, are willing to cut their prices downwards. So just now, all that we have shared is to share the psychology of the entire macro market, as well as what existing homeowners are thinking about, and why are they buying private properties, how are they using it, and why do they want to own. And we talk about the blackout period, motivation to exit at low price, and is there really such a motivation to really fire sale their property, since everybody most of the time are owning one to enjoy the property. So disparity effect is basically a methodology that we have developed. This is basically for us to find out in certain seasons, let's say in 2023 or 2024 next year, what are specific types of properties, what are the specific types of price ranges that are due for a up-leg movement. Because certain properties, they have already moved up pretty fast in maybe previous seasons. Let's say, for example, in the year 2020 to 2021, inter-terraces, freehold, and triple nines are moving up so quickly that it was just moving at an acceleration speed that a lot of people were taken by surprise. But by year 2021, the price acceleration actually stabilizes, and the next movement was actually semi-D homes. So semi-D actually rose from 2021 all the way to 2022, and the acceleration of semi-Ds back then was faster than inter-terrace during that season. So that is an example of what we mean by finding the disparity effect, because certain seasons, certain properties will move faster than other types of properties. And if you can hunt for these type of properties, then it will actually accelerate your entire portfolio journey, because we cannot buy back time. We cannot go back to the time that we are 25 years old or 30 years old. And thus, by exiting the market is already a first risk. By not going into the correct type of properties is a second risk. So disparity effect is to help us to find the correct type of properties and projects to enter into. Just a quick example here. These are two illustrations. If let's say somebody is thinking about comparing two different types of 99s property, one can be a new launch, one can be a resale. So for example, if let's say we assume the quantum price will be the same, but maybe for the new launch is smaller, resale is bigger, what we want to do as a first realm of check is to find out whether is there any disparity when we reset both properties to a full 99 years pricing. Now, if we were to reset them based on their balance list, and then we divide by the existing PSF, and we multiply back to a full 99 years, you're going to see that for this illustration, the resale is actually at 2193 PSF. Although on the surface, you're buying 1971 PSF, you might think that this is lower than the new launch. But in this scenario, when you reset back to 99 years, a full fresh list, this resale property actually costs more than the new launch. So in this case, there is no disparity advantage to buy the resale property. It makes more sense to go for the brand new project. Let's have a look at the second example. This is an illustration that in certain developments, facings play a difference. Because some facings might be facing towards, let's say, an expressway facing. Some facing will be facing, let's say, a pool facing. Does it make sense to pay for a price premium because of a different stack? Does it mean that by paying for a top dollar property with a higher quantum for the better facing, does it mean that you'll see more appreciation 3 to 4 years later when you collect your keys? Sometimes you will also see certain layouts, but they are at the same size, but the price premium is drastically different. Maybe it could be because of a low floor versus a high floor. Does it also mean that the low floor will not see appreciation and high floor will see more appreciation? So this is an example of how we look at disparity effect based on layout plans as well.
Okay. So we can also use the disparity effect on property types. And so in this scenario, if we look at new launch landed prices as well as new launch condo pricing, something that's very interesting that we observe at the current juncture is that for new launch condo, a lot of these 4 bedrooms, they are priced at 3.2 million all the way until 3.8 million with an average square size, with an average floor size of about 1,400 square feet, about $2,500 in terms of PSF. But what if you're able to find the same 99-year brand new landed property at 3.6 million, but now with a 4,000 square feet of build up, which then actually translates to $900 per square. Because most of the time, landed properties, we always use $3.6 million, we divide by the land size, and the per square feet will be higher. But if we were to use a vis-a-vis comparing with a condo in this current juncture, we realize that actually we can see that if the price gap is the same, then this pure landed brand new 99 years might be a better gem as compared to the new launch condos at the same kind of price quantum. So you can also use the PLB disparity effect on the types and condition of landed property. So we have 4 categories of landed. Cat 1, meant for rebuild. Cat 2 for A&A. Cat 3 is for minor renovation to move in. Cat 4 are brand new from developers. And in this scenario, if let's say, for example, inter-terrace for the different categories are at this pricing, and semi-detached in the same timeline is at the pricing below, which one will you think that will be a better buy that gives you more price acceleration in the next 3 years to come? Assuming that if you buy a brand new landed property, freehold, 5 million to 5.8 million, at the same time, at the same price point in the same district, you can actually buy a Cat 2 home that is also at a similar quantum of 5.5 million. So in this scenario where we say when the price disparity is very close, we always go for the better asset type. So in this case, the semi-D Cat 2 homes will definitely see a better price acceleration in the years to come as compared to getting a brand new Cat 4 interterrace. And lastly, we can also use the disparity effect on tenure as well as the age of landed property. So a lot of times, how we use disparity effect is that we do not want to compare things just purely on the surface value because properties are not apple-to-apple comparison. We will need to add in different angles and perspectives to analyze these properties such that we can compare them in a better, fairer manner so that we can understand where is the untapped potential that we can position our funds to have better outcome in the years to come. So in this scenario, 99 years landed, which are already 25 years old, is at $2.9 million, and a brand new landed is at $3.6 million. And of course, if we were to compare a freehold 99 years old interterrace at $4 million, we will see that the price disparity in terms of gap-wise is about 700K and 400K over here. So over here, we might think that maybe it makes more sense for me to just get old 99 years standard because I can save $700,000. But what happens is, on the surface is that when I get a 99 years landed that is 25 years old, I probably have to redo the entire interior of the space, investing about $600,000. That makes my entry price for this landed property to be $3.5 million, which is only $100,000 gap for a brand new landed property which has the full runway of 99 years lease. And for that freehold property of $4 million, they are actually like a Cat 1 home, which probably will need someone to pump in $1.6 million to rebuild, bringing up the pricing to $5.6 million. And in this scenario, when we combine all these perspectives together, we realize that actually the 99 years brand new landed in this scenario might be the better buy to position your funds in this current season. So of course, we can combine PLB's disparity effect with our mode analysis that some of y'all might have already known. We analyze properties based on these 7 analytical factors over here, and we build it into a system where it's called our PLB mode analysis, and every resale project, we are able to give it a mode score. So every single property, every single factor, we are able to give it a mode score. And so at a quick overview, at a glance, our consultants are able to tell you which projects are ranked better in terms of percentage, in terms of the scoring, and these are the projects that are actually going to have more potential in terms of the years to come. Of course, combined with our other PLB signature strategies, that's how we help our clients to develop the correct strategy, to implement the right kind of property strategy in terms of their current life stage in their property investment journey, and to make the best property selection using a disparity effect as well as the mode analysis. So going back to Melvin. Yeah.
All right, so welcome to the end of our webinar. If you're keen in our content, head on to YouTube. We have 3 different channels, PropertyLimBrothers, where you get to enjoy different types of home tours, also different varying types of contents. Our vlogs are there as well. NOTG is the place that we interview different people, entrepreneurs, people with a real estate interest and finance interest, and we also banter different real estate trendings and news and topics as well. We also have PLB Insights, where we analyze different new launches. And this year, up to date, we have covered almost all the new launches available in the market. So head on there if you want to have a look at new launch review series. And if you head on to our website, our newly revamped website also has all the listings information for properties that we're currently representing sellers to sell. And also, this is our next 2 channels. I want to end our webinar. Thank you for staying tuned with us. My name is Melvin Lim.
My name is Rong.
I hope to see you on the next webinar. Take care.